Hello, I'm Ernie Humphrey, the Director of Content for the CFO Alliance. I would like to welcome everyone to today's webinar, Cultivating a High-Performance Team, Benchmarking Incentive Compensation Programs and Leveraging HR Analytics. We have a strong commitment to offering you the ROI you deserve for your valuable time. So our learning objectives offer you our promise to you in terms of specific takeaways for you from today's webinar. After the webinar, we hope that you'll get an understanding of current trends relative to the incentive compensation programs leveraged by mid-market companies, be able to start to construct benchmarks for your company's incentive compensation programs, and identify opportunities for your company to leverage HR analytics to impact the performance of your employees across the enterprise. Just a few housekeeping notes. The slides are currently available under the handouts area in your GoToWebinar control panel. We'd like to hear from you today, so please feel free to ask questions during the webinar at any time during the webinar using the questions area in your GoToWebinar control panel. Please note we're going to be asking you to take 3 polling questions during the webinar, and we appreciate your consideration in answering all of our polling questions. If you're interested in receiving CPE credits for today's webinar, you will have to answer all of our polling questions. Finally, we appreciate your consideration in taking a short survey at the end of our webinar today, as we always strive to improve the ROI we offer our event attendees for their valuable time. A few quick words about the CFO Alliance. We are a community of over 6,500 financial professionals. Our mission is to share experiences and knowledge that empower our members to embrace the evolving role of the Office of the CFO and to deliver value at their companies. Another key part of our mission is to offer a multidimensional value proposition through in-person events, webinars, virtual interaction, and a rich knowledge base. Now, I want to take a step back and go back to how we're going to accomplish our learning objectives for today. I'm going to be our first speaker here today, and what I'm going to do is I'm going to give some background on the 2016 CFO Alliance Middle Market Executive Compensation Study, and then what I'm going to do is review some of the key study survey results, and then I'm going to take us to the next level and talk about some of the key implications from the survey. And then what I'm going to do is I'm going to hand the floor over to my other featured speaker today, Jeff Higgins, and he's going to give us an overview of HR people and workforce analytics and give us some great insights into our defining, monitoring, and leveraging HR analytics. And then we're going to close up our session today with a Q&A session. So let me start out with a little background in terms of our mid-market executive compensation survey. The outlook of CFOs going into 2016 we found was quite optimistic, and this was according to the 2016 CFO Alliance CFO Sentiment Study, which had a response rate of over 600 CFOs across the country. 72% of respondents categorized the state of the industries in which they operated as strong, expected to see higher top-line revenue in 2016, and 58% expected to see higher company earnings in 2016. And then also, the vast majority of CFOs realize that hiring and retaining the human capital would be critical in delivering results in 2016. So again, going into 2016, CFOs realize that in order to meet these optimistic expectations, they would have to do a great job in hiring and retaining the right human capital. So what we did at the CFO Alliance in the third quarter is we introduced our CFO Alliance Pulse Survey in order to see if CFOs were going to meet these expectations in 2016, and if not, why. So what we found was pretty compelling. The vast majority of CFOs reported that top-line revenue was going to be a shortfall, and then 27% reported the main reason would be due to not having enough and or the right human capital to deliver on expectations. So on the top-line revenue side, not meeting growth targets, a main reason for that was not having enough or the right human capital. And then on the cost side, 47% reported the main driver for higher than expected costs was due to human capital and training costs. So what we found was going into 2016, CFOs thought that human capital optimization was going to be critical to delivering results in 2016. And then what we saw with our Pulse survey was this in fact, was going to come to fruition. So this leads us to, it was evident that there's very challenging conditions in terms of hiring and retaining the right talent. So I wanted to look at the incentive compensations in place and see if companies were adjusting incentive compensation programs to address these shortfalls, and if so, how that was taking place. A little more survey background. We distributed the survey to middle market organizations and over 5,000 CFO Alliance members and other senior finance leaders across the country. We had 184 organizations that participated in the survey, which was up from last year. And then in terms of our main survey objectives, our survey was different from other surveys that I've seen in this front on a few fronts. One of the objectives was to allow companies to benchmark the designs and types of incentive compensation plans offered, allow companies and company leaders to benchmark the components and total compensation of finance, marketing, and sales leader. And lastly, we wanted to allow companies to benchmark and identify and quantify trends in short-term and long-term incentive compensation plans, including looking at if the use of non-financial metrics in the design of compensation plans was starting to happen. So what you'll see oftentimes in salary surveys is it's just meant to be a benchmark. So a CFO, the salary is $250,000. Boom, across all industries. Okay, so it's just looking at that one number. It's not really looking at trends in compensation, and it's really not digging into the components of incentive compensation. And also, what's always seems to be missing is that what's happening to the design of the incentive compensation programs. Are they changing, and then why are they changing? So a few more industry survey demographics. Again, I just want to mention that the slides are currently available, so this is going to be a lot of information to take in. So the good news is you'll have the slides, and then the other good news is that at the end of the webinar, you'll have the opportunity to reach out to the CFO Alliance and request a copy of the full survey report, which goes into even more detail than we are going to address in the survey. I think it's some very compelling and unique information. So in terms of the top industries represented, you'll see some of the top industries, which are pretty consistent year over year for us: manufacturing, technology, wholesale, retail, business services, and finance and banking. So what you'll see in the full survey report is a much deeper dive into the results that I'm going to go over in terms of industries and also the annual revenue size of the companies that participated in that survey. So more survey demographics, just to give you a sense of our response audience. We had a vast majority of privately owned companies, and then you'll see the geographic distribution of survey responses. So obviously the demographics are very important in terms of benchmarking, whether you're looking at salary components or trends. So it's always important to understand the demographics of the survey. There definitely can be a great starting point, but again, as always, I want to caution on making too many inferences based on one survey data point. So you need to really dig into the results. So if you want any more information or insights into the survey results, I will be happy to address that with anyone on the webinar at a future time. Again, in terms of annual revenue, the vast majority of our respondents were between 10 and 49 million, and between the 50 million and 250 million dollar range. Again, so just giving you a sense of that. So let's take a quick look at some of the compensation results. So what I'll do is I'll start at the high level. So we'll take a look at these results really quickly. Again, a lot of information to digest. Again, it's a good idea to take a look at the slides after the webinar, and then if you have any questions or want further insights, please go ahead and reach out to us. So some of the things that really stuck out to me were that on the CEO side, I expected there to be a little bit more of the population over in the 500 to 750K and above 750K side of the chart. And also, I found it pretty interesting that on the sales side, there was such a difference in terms of being under $100,000 for the base salary. Obviously, in general, sales compensation is based on commissions and so forth. But I thought when we got up to the top sales executives, I might see a little bit more, a little bit of a higher base there. So again, a quick overview there. In terms of short-term incentives, I think some of these results are self-evident, and what really stood out to me was that if you look at the short-term incentives, and we'll look at the long-term incentives as well, what I found compelling was if you look at the difference between CEO and CFO, what we'll see is there's more of a tilt to the CFO on the short term and on the CEO on the long-term side of the compensation in terms of the amounts there. And then if you look at sales executive and marketing executives, you will see that same trend there. So again, we'll look at base salary. Let's look at short-term incentives, and now we'll dive a little deeper into short-term incentive compensation. So some of the things that I find compelling to dig in, and one of them is just the eligibility. So let's just take a look at the eligibility of short-term incentive programs. So again, if you're looking at what's going on in your organization, you might want to take a look at, okay, who's eligible, top sales executive, is that something that's expected, is that something that I need to reconsider? So we see obviously a high percentage of CEOs and CFOs, and then as we go from top sales executives, a little bit higher on the top marketing executive side. And then if we dig in a little deeper, again, what I think is really unique about the study is how deep of a dive that we take into the, okay, what is the number, how is the number made up, and then we'll look at the dynamics there as well. So we'll look at the top short-term incentive plans offered. The companies could obviously choose more than one. The most common types of short-term incentive plans offered were discretionary bonus and an annual incentive plan. I was a little bit surprised to see that there weren't more responses in the team small group incentives, and I think that's where some of the incentive compensation really needs to go, just based on some of the information that we saw at the beginning of the year in terms of the key drivers of company value. The majority of those, I think 3 of the top 5 were related to the customer. And so the drivers are really going to be related to more non-financial assets. So I think these group incentives based on some of these customer metrics are going to be more important, and there needs to be better alignment between the incentives and then the values of company drivers. And we'll talk a little bit about more of that in a few minutes. So now with that, I'm going to go ahead and launch our first polling question. So our first polling question is asking you to share with us which of the following performance metrics your company uses to determine short-term incentive compensation. Again, I appreciate everyone's consideration in answering all of our polling questions here today. And those of you who are after CPE credits for today's webinar, you will have to answer all the polling questions during our webinar. Also want to remind everyone that we would still love to have your questions in the questions panel of your GoToWebinar control panel. So in order to be mindful of our time, I'm going to go ahead and close the polling question here, and then we're going to take a quick look at the results, and then what we're going to do is take a look at how those results from our audience compared with what we saw in our survey results. So I'm going to go ahead and close that, and then what we'll see is a little bit unexpected. I did expect to see a high amount net income, retained earnings, revenue, individual performance rating, and I'm a little surprised to see nothing on the customer churn area, retention, and then the cash flow area. So what we'll see when we look at the survey results is we'll see much more of the population down there, and I think those bottom 2 numbers are really where we're going to need to see more incentive compensation programs going. Again, this can be related to your industry, especially if you're in an industry in a subscription economy or a recurring revenue model. I think those are going to be more and more important. So let's take a quick look over here. As I mentioned, same, net income, earnings, and revenue, but there was a lot more that we're seeing from our survey than we saw from our audience survey in terms of individual goals or individual performance rating. Again, even in these survey results, I expected to see a little bit more on the customer churn, employee satisfaction, and cash flow as well. So moving forward over the next 5 to 10 years, I would almost expect this to flip a little bit more. I know it's a paradigm shift, but I think we're going to see a little bit of a shift away from just using revenue and net income and earnings to non-financial metrics. So we looked at what are the performance metrics, and then we wanted to take a little bit of a deeper dive into what's the basis for setting performance targets. So we looked at some top measurements there. The top ones were budget, management discretion, year-over-year improvement, and so forth. And one of the areas that I think is going to increase here is performance relative to peer benchmarks. So I think as data becomes more available in the era on big data, and a lot of these companies there's a lot more companies out there that are aggregating data, and that data is being made available. So I think the availability of peer benchmarks is going to continue to grow, and it's grown quite a bit over the last 5 to 10 years in terms of private companies. When I was a finance practitioner, I was in charge of competitive intelligence, and I always had trouble getting some benchmarks around privately traded competitors, but I think there's a paradigm shift going on there as well. So I think these results are interesting, and we're interested to see how these results change over the next 5 to 10 years. So we also want to take a look at what are the dynamics. So going into 2016, it was clear that human capital and other factors were going to really drive results. And so we wanted to look at in terms of companies that are adding short-term incentive programs, which ones are the top ones, and then also take a dive a little bit deeper into what are the driving forces. So some of the short-term incentive plans that were added this year are going to be added next year. Annual incentive plans, spot awards. I was glad to see that. So I like spot awards in some sense due to the fact that those can change and be dynamics, and they're not always completely baked in the budgets. And again, this goes along with my earlier comment, but I'd like to see more in the team small group incentive side. And then I think this other graph is really compelling as well. Sort of the driving forces. Very happy to see better alignment with key drivers of business performance. So I think that's really good news that that's a key driver, because I think as CFOs and company executives become more and more educated as to what's really driving their business values, they're going to realize that some of these incentive programs need to shift to focus on metrics and tying performance to non-financial assets. So some of the other ones, just to mention, weren't too surprising: company growth, changes in company strategy, and so I think, again, I was very happy to see the focus is better alignment with key drivers of business performance, and I think that's also being driven by the availability of data and also systems that are focused on helping companies manage performance across the enterprise. So now let's shift the next few minutes to compensation results on 2016 long-term incentives. And then again, we looked at long-term incentives. I forgot to note, in terms of the positions that we looked at CEO and CFO, and then we looked at the top sales executive, the top marketing executive, and we also looked at the accounting manager and controller position. So we pivoted a little bit in our study this year from last year, in that we looked at less positions, but we did a much deeper dive into these positions and the dynamics behind the components of the incentive compensation programs, and also the dynamics around them. So a few points here, as I mentioned, in terms of on the top side, what you'll see is long-term incentives. The CEOs obviously have that big incentive out there, almost the bingo side, right? It's the lottery CEO long-term incentive to keep them there as they're driving the company's strategy. And then what I'll note, a little surprising was I was expected to see a little bit more of a difference on the top sales and marketing executives. I would have expected to see a little bit more on the very top side for the sales executives as well. But again, if you really want to get into interpreting these results and making inferences, it's important that we'd want to dig a little bit deeper and take a look at the industries and the company size as well if we're going to make any inferences relative to the data. So again, with the long-term incentives, just how we dove into the short-term incentives. Okay, what are the long-term incentive compensations offered? Again, some really compelling benchmarking data. Most common, stock options, restricted stock, and phantom stock. And then in terms of some dynamics there, long-term incentive programs added in 2016 or to be added in 2017, I believe the survey showed that 11% of companies would be changing long-term incentives in some form in 2016 or 2017. And in terms of short-term incentives, 46% of companies were actually going to be making some changes along those lines. So in terms of short-term incentives, we're seeing some real dynamics going on, and I think over the next few years we're going to see that dynamic in long-term incentives start to change as well as people get a better sense and adjust to what the recurring revenue economy looks like for their firms. So in terms of changes implemented, top changes adding one or more performance measures, which is good to see. I would hope that some of those performance measures would be relative to customer metrics, raising performance goals, and so those are some of the top ones. And then the performance metrics leverage in terms of long-term compensation. What we see is pretty consistent with short-term. Again, we have financial results, revenue, annual sales, profitability, and we're not seeing as much as I would have thought on the customer retention, customer churn side, and client customer satisfaction, but that number is getting up to the 10% mark. And again, I think as company leaders become more educated in this area, that we're going to see much more dynamics in terms of those areas. So now with that, I'll go ahead and launch our next polling question. Our next polling question is asking you to share if your company is going to be revising or rising your short-term or long-term incentive programs, and have you done that in 2016, or are you going to do that in 2017? Again, we appreciate everyone's consideration in answering all of our polling questions today, and we would still love your questions in the Q&A box of your GoToWebinar control panel. In order to be mindful of our time, I'm going to go ahead and leave that survey up for another 10 seconds or so, and then we're going to take a quick look here and a few quick comments on my side. So I'm happy to see that number is 55%. So that is even higher than what we saw in our survey. So that's good to see. So it's apparent that those in the audience today realize that there needs to be some work to be done in order to properly incent the employees across the enterprise to empower them to reach those optimistic expectations, which we saw in going into 2016. So I'm going to wrap up my comments with some overarching key survey results. And there's two key survey results, but there's an awful lot below those results. Companies are beginning to realize that an incentive compensation plan need to be adjusted to align with key drivers of company value. Fantastic. 45% of respondents added or revised short-term programs in 2016 or plan to do so in 2017. Again, what we saw from your attendee polling question was even more of you are planning to do so. Of companies that have or will have changes are being driven by changes relative to the following performance metrics. Again, we mentioned those: goals, performance rating, net income, and then it's good on the short-term side. Again, if you look at customer churn, 13% in cash flow, 12%. I'm glad to see those. I think those will go higher. And then it's important to benchmark the top 3 forces behind changes and impending changes. Again, better alignment with key drivers of business performance, 27%, and company growth, 23%. And then the other overarching point that I'd like to make is that companies are beginning to realize that incentive compensation plans are, again, more and more background here. 10% of survey responses adding or revised long-term incentive compensation plans. Again, this slide just reviews some of those graphs, and you can review that after the webinar is over and just look at the components, and then more importantly, some of the driving forces, and see if those are things that are happening in your company as well. And my other key conclusion is that going into 2017, it's evident CFOs need to be even more focused on how to acquire and retain the best talent, and I call that winning the war for finance talent. And these are really compelling, maybe the most compelling results of the survey that I found. Only 51% of companies believe they have the proper incentives in place to optimize customer satisfaction, which was shown to be a key driver of company value. Yet, less than 3% reported changing or pending changes in short-term incentive compensation to customer-focused metrics, and only 10% any changes to long-term incentive programs in 2016 or to take place in 2017. Only 40% of companies believe they have the proper incentives in place to optimize the quality of business processes, another key driver of company value identified in 2016. Only 53% of companies believe their companies have the proper incentives in place to attract and retain the best talent, a big focus of the webinar. We have seen the impact that has on delivering company results. And only 44% of companies believe their companies have the proper incentives in place to protect and enhance their company's brand. So this last point makes it crystal clear that there needs to be work in terms of incentive compensation, and there needs to be alignment between the incentives and these key drivers of firm value, which are transforming to be based on non-financial assets. So with that, it is my distinct pleasure to welcome our second featured speaker today, Jeff Higgins, founder and CEO, Human Capital Management Institute. Jeff is a global thought leader with 25 years of combined workforce planning, analytics, and finance experience supporting Fortune 500 companies. He's helped organizations around the world quantify the ROI of workforce decisions and realize cost savings opportunities up to $1 billion. Jeff is a former senior HR executive and a former CFO and a regular speaker at HR events. Jeff, I'm going to hand the floor over to you. Thank you very much. Please take it away.
Thank you, Ernie. Next slide. And you gave away the punchline, which is that I'm a former CFO who actually worked in HR, and so I jokingly say that I speak both languages, and we'll explain more what that means in just a minute. So kind of segueing into from the compensation survey and some of the metrics, so we're going to get a little bit more into human capital metrics, which would be some of the non-financial asset type metrics. And I'm actually going to toss out a couple that I think are outstanding. In fact, we found them to be very predictive for publicly listed companies, a lot of the larger entities, to be very predictive of future stock price movement. And we'll chat more about that in a moment. Bottom line, why should we care about human capital other than as a cost to be minimized? Because that's really, in essence, in pure accounting, how we measure it. Well, there's actually a huge body of work showing that the source, kind of the source of the spring, the flow of productivity and value creation is created by people. And while measuring them as a cost is absolutely key to the business, that's how you kind of keep your eye on the ball. There's also another ball, which is the outputs that people provide. What's also interesting is that actually institutional investors, in fact, to name just a couple, the HCM Coalition, a group of 25 institutional investors, mostly we're talking about pension fund organizations, so $2.5 trillion literally literally 2.5% of all of the U.S.'s net worth, are actually engaging with mostly publicly listed companies and asking for greater disclosure of human capital. There's a large body of work that says that people really are the source of value creation. A lot of CEOs would say people are the most valuable asset. Obviously, the most valuable asset not listed on the balance sheet, certainly on the positive side. And so institutional investors are actually asking, and the Dow Jones Sustainability Index actually recently added a new metric called human capital ROI ratio, which is a cost-based rate of return on your human capital metric. And we'll actually share a little more with you about that in a minute. Next slide, please. So I'm going to fly through a few of these slides so we can kind of get to the meat, a couple of case studies, and actually introduce a couple of these metrics, give you a couple of formulas. So, one thing that we try to do in many cases is build a bridge to HR. In many cases, you may actually have HR reporting to you if you're a CFO or controller. And a lot of times HR struggles to connect to finance. In fact, when I was a CFO, I can tell you how critical HR was to the business. I forgot HR reported to me. That's not something I'm proud of, but it was true. And that was really my bad, because there was a lot of opportunity to really try to get some of those upstream, more predictive metrics that might have been able to help drive business performance farther downstream. Profit is the ultimate lagging metric. It's the remainder. It's what's left after everything else is done. So really, there's an opportunity to find some new KPIs, get some literally by means of measures and metrics, new tools for the tool belt. Next slide, please. So one way to start to think about it is with questions. So I'm going to toss out, I'm not going to walk through all 7 of these, but let's start with number 1. What's our workforce productivity? Is it improving? How do we rank? Quite literally, what is our workforce? That's something that CFOs are actually supposed to know. What's our productivity? Well, isn't that revenue per FTE? Yes, but we all know that every FTE, every headcount is not equal. The receptionist is not of equal value creation to the top salesperson. The CFO is not creating the same amount of value as the night shift maintenance cleaner. So the problem with revenue and profit per FTE, which are commonly used, is that it averages out across everyone. So and by the way, we've done some statistical research, not very predictive. There's a cost-based productivity, which weights every job based on how much is paid. That creates the natural differentiation. And by the way, that's what we care about. Companies vote with their dollars, and so the positions that are paid more, generally speaking, are more important and more impactful in any organization. So by assigning a dollar weighting to the positions, and basically whether you're going to hire more high-end or more experienced positions that cost a lot more, or a lot more junior, less experienced that cost less, and see ideally which sales force, the more experienced or the less experienced, where you can hire more of them, which one would actually provide more output in terms of sales and new customers and delight the customers. You can get into things like predicting our sales stars. Where do we get our best? So if every time you had a new position open and the replacement was 20 or 25% more productive, that would show up in your top line, and it would ultimately show up in your bottom line, and the marginal cost could be little or nothing. I also talked about number 3. So 1 and 3 are very closely related. What's the right size and cost of workforce? By the way, there's some simple tools available on our website, and I'll hopefully we'll get a chance to show you a couple of those in a few slides, called an impact statement, where you can actually do a calculation that works to quantify that. And then you can even get into things that are a little bit deeper down into, which is whether it's better to build by rent talent, ROI of training, critical roles, and actually quantifying leadership. In fact, we're going to show you a high-level, very quick case study on the quantification of leadership. That's kind of the bleeding edge of frontier of predictive analytics, is actually quantifying the value that stronger leaders can provide to an organization versus weaker leaders. Next slide, please. So this is a fun one. Yeah, so yeah, we'll skip the drama. We can just go right through these. So, what HR thinks, and by the way, since I worked in HR, and I often get stuck in the room as kind of the translator, HR on one side of the table and finance on the other side. HR would say finance just doesn't get it. They see people as numbers. They say no to every HR project. By the way, absolutely spot on for me. I was a close business partner with HR, which meant I said no to virtually everything they wanted. Training is critical to success, and HR would say talent is key to long-term success and need to invest in talent. And so on the finance side, what do we say? We say, well, HR just doesn't get it. They're speaking their own language, and they expect us to learn that language, which is honestly, HR is wrong. They're never going to get the rest of the world, the rest of business to speak HR. They need to learn to speak a little bit better finance. They need to put things in dollars. Warm and fuzzy doesn't pay the bills. HR can't show a good business case, but would probably agree, yes, training is critical to business. Where we differ is how much. And that talent is definitely a key to long-term success. We need to attract it, retain it, motivate it, and pay it properly. And we need to invest in talent. So the funny thing is, while opposite sides of an issue, the first three, when you get to the bottom three on each side, actually more or less align. So there's really a need to bridge the gap language-wise. And by the way, in terms of learning a new language, it's really more HR that needs to learn to be able to present information from a financial standpoint. And guess who needs to help teach them how to do that? Finance and accounting. So HR, if they're really going to kind of get there and you're going to be able to get the value out of them, you need to help them basically learn how to build a better business case. Show me the money. I like to show this slide. So a lot of CFOs say, what is this, this analytics stuff? What can you get with it? That's why we show some little pots of gold here. And I'm just going to touch on these quickly. In fact, the number one item here is from UPS, and it's the ROI of leadership. We're going to show you that case study in a minute. Number two is predicting sales stars. If you could literally, every time you're going to hire a salesperson, if you had not a guarantee, but a very high probability that you're going to pick someone who's going to outperform, perform well above average, you'd actually be pulling your average, basically your revenue per salesperson. Hopefully the same, at higher, even better margins. You would be driving, so to speak, your outputs, revenues, new customers, satisfied customers, and ultimately impacting the bottom line profitability really well. ROI of sales training, some training really can drive. Location optimization are the places we can go to get better talent that actually costs less. And by the way, you can have your cake and eat it too. With good analytics, you can actually figure out where to get better talent that costs less. And for those of you that are sports fans, baseball, with the Chicago Cubs just having won the World Series. Well, remember the book Moneyball about the Oakland A's. That's exactly what they did. And by the way, this is a little bit of what the Chicago Cubs did. They brought in a lot of young talent, trained them, groomed them, and ultimately resulted in a World Series championship. Even engagement can actually grow the top line revenue. Delighted people, highly engaged people actually will give what's called, and I used to be a skeptic of this, what's called discretionary effort. They'll go outside and above the job description. They'll give a little bit more effort to the company, and that results in cost savings projects. That also results in more delighted customers, which can positively impact revenue. And then, of course, there's the savings to better retention, reducing turnover, and even building versus buying talent. Next slide. So we jokingly say that there's literally pots of gold buried everywhere in human capital in the backyard of most organizations from a human capital analytics standpoint. So how do we do this? Well, can we just grab a couple of traditional metrics, throw them on a board, and hope nobody asks any really tough questions like revenue and profit per FTE? Good, but absolutely not predictive. Or number two, can we find a couple of really advanced metrics? And by the way, one of them I already mentioned, human capital ROI ratio, which there's a formula here, and when you download the slides, you can actually see more. Or even better, can we put them in a framework that has a flow that tells a story, like financial statements? I mean, really, the ultimate storytelling framework is financial statements, the income statement, balance sheet, and cash flow. HR has nothing like that. It's something they need. And by the way, we're going to show you a draft of something which is actually being worked on the HR side that you might find interesting and useful, and maybe you can even partner with HR to get them to work on it and complete it. Next slide, please. So, okay, so diving in. So we're really going to dive through this slide very quickly. This is, we're calling it global package providers, but it's actually UPS. And they asked an important question. Let's go to the next slide, and I'll explain more. So very large organization, 400,000 employees. They asked the key question, does leadership matter? And so we took their distribution center managers, that have 3,000 centers around the world that have anywhere from 60 to 300 employees on average. And so this is really the leader for those centers. And they're evaluated across 10 different competency scores. So UPS really hires, trains, promotes, develops, uses everything around these competencies. But they came to us with a question, and they said, does leadership really matter? And if so, what's it worth? And that's the real key question. Of course, leadership matters, but is it worth a little, or is it worth a lot? Or is the differential between the best and the worst really worth worrying about? The good news for them, the competencies did matter, although some competencies, like results orientation, basically finding how to overcome obstacles and get the job done, as well as teamwork and communication, were 3 to 5x more impactful, more predictive than other competencies. So that actually enabled UPS to adjust their weightings and really select, train, and improve the overall quality of the leadership. How did that show up? How did that manifest? Well, if you look at year one and actually year two results, the blue bar is the top 25% of managers. And the orangish bar is the bottom 25% of managers. What you see is a difference in cost. So this is cost per piece shipped. So you see a difference in year two of about 20 cents in cost per piece shipped, 15% lower. You think 20 cents, that's nothing. Well, if you're UPS and you're moving billions of packages, actually it's $500 to $700 million USD a year that the higher performing leaders are able to get. Basically, they're able to improve the throughput. Think of it, whether you're managing manufacturing, customer service, even call centers, improving the throughput so you can basically serve more, do more with the same size workforce, lowers the cost and dramatically increases the productivity. Well, they must be walking across a catwalk, cracking a whip, yelling at everybody, do more, do more, do more. Well, not exactly. If we go to the next slide, these same center managers were not only getting more of all the good stuff, they were getting less of the bad stuff. A 75% reduction in what we would call adverse events, which is loss and damage. So, by the way, for those of us that are customers of UPS, that means packages that are arriving that are not all beat up and broken. Look at that, 75% reduction. By the way, in these centers that had the top performing, basically the blue bar, you can see the very low, it's an adverse event, you want the low bar. The UPS drivers actually had fewer accidents, less absenteeism, lower turnover rate, higher engagement. So what these leaders were doing was not only getting more productivity, getting more of all the good stuff, they were getting less of all the bad stuff. And obviously the scope of the dollars is enormous if you can basically find the right leaders to juice productivity and get 15% more out of the workforce. So that's just an example, and really one of the biggest ROIs we've ever found, of the potential for finding some of key analytics and key drivers to actually help build and really make your P&L come to life with better performance at the top and bottom line. Now another metric, which is we already talked about, and I've kind of picked on it a little bit, but as I said, it's good, it's just not great, and it's not strongly predictive. This is a biotechnology company which wanted to do a benchmarking of their workforce productivity, so answering that first question we mentioned. And you can see that in year one in 2012 and 2013, and actually we've subsequently done 14 and 15, they look like they're number one in their industry. So, and actually this is because they're all public listed companies that are being benchmarked. They already knew that. Well, let's order the champagne. Oops, actually, if you're reading the slide, you can see that while they rank number one, don't celebrate yet. Let's go to the next slide. Now, here's where it gets interesting. On the simple metrics, revenue and profit per FTE, they are number one. But when we bring in the metrics that are much more predictive, much more powerful, the cost-based metrics I mentioned at the beginning, you may be starting to hear the theme, which is human capital ROI ratio is the vertical axis, and return, which is basically gross margin your basically gross profit contribution per dollar of workforce cost, or as we like to call it, TCOW, total cost of workforce. That's the all-in, salaries, incentives, overtime, benefits costs. It does not include things like fixed, like utilities costs or allocation for computer or office space. So, but it's all the direct person costs, so everything associated with their pay, incentives, and benefits is in that. Actually, they are number three. So that's why we say hold on the champagne. On the metrics, everybody knows the simple ones. If you just allocate number of bodies by revenue or profit, they look great. But in reality, their workforce is very expensive, and so for every dollar they're investing, they're actually in third place, not first place. So that's why they have more work basically to be done. In fact, if you look at the bottom two charts, the bars, and they're comparing both one on the left, the human capital ROI ratio, and on the right, the return on human capital investment on a compound annual basis. You can see that the dark blue shows that the good news is they're improving on these metrics, so that's great. Kudos to them. Nothing more powerful and predictive than consistent improvement, and this is, by the way, 3-year improvement for them. However, the bad news, somebody else is improving faster. So if you think of rate of change, rate of improvement is driving the speed at which your race car is moving. Good thing is they're in third place and they're looking good. They're the second, but being second fastest doesn't mean you're going to win the race. So that's why they truly have more work to be done. Next slide, please. So now, okay, great. So we've got time. So if we were going to actually go beyond just picking a metric like human capital ROI ratio or total cost of workforce versus as a percentage of revenue, percentage of other expenses, by the way, those are some great non-traditional productivity KPIs that you can introduce into your businesses. If we were going to actually take these and put these into more of a form and a flow, kind of like financial statements, which, by the way, unsurprisingly, given my background and others in HCMI, we actually have modeled a little bit after some of the insights and the function and utility of financial statements. So let's take a look, and I'll show you what you can do if you were to create a set of statements, kind of like financial statements. A few similarities, but not too close. But bringing over some of that utility into a story about human capital. So next slide, please. Okay, apologies. I forgot to, here are, by the way, so if you're saying, what are these metrics and how are they calculated, here's the formulas for you. I'm not going to spend too much time other than to say, by the way, and this was my bad as a former CFO. I always knew how to drive productivity as a CFO by managing the red ball, the inputs. Basically, your productivity is your outputs minus inputs equals what's left over with remainder, which is generally your profits, pre-tax profit or net after-tax profit, depending on how you calculate it. However, I never took any responsibility for the blue ball. I was always trying to manage, shrink that. If I could shrink the red ball, keep the blue ball the same, we have more profit. However, you can't really shrink the red ball to zero. No way. Law of diminishing returns, you're never going to get it. However, you can grow the blue ball in perpetuity. There is no outside limit to the blue ball. Again, if every time you're hiring a position, that person is 25, maybe even 250% more productive than the last person who was in it. Or if you're increasing the productivity, you're getting the right leaders, or your engagement scores are getting people to give more of that discretionary effort. The blue ball is going to go up, and by the way, the marginal cost of high engagement, great leaders is generally zero. So you get more of the blue ball, more of the outputs, and no cost increase. That's what makes it powerful. And here are the formulas you can use to calculate human capital ROI ratio, return on human capital investment. And the denominator of both of those is the total cost of workforce that I described. Now let's go into the actual forms and show you a couple of statements that you can use these metrics and to actually tell a story and get some insights. Here we go. So this is called a summary impact statement. And the funny thing is, you might smile when I tell you this, we show this to HR folks because we actually spent time trying to train and get HR to actually prepare this to partner up with, again, put things in a financial perspective to bridge that gap so that CFOs and controllers can actually get what the message that HR is trying to deliver, get everybody on the same page. And really, we're trying to teach them to speak the language of business, which is money. So you see the black numbers are basically all from the financials except for headcount, but that's something that's pretty easy to get. So you got revenue, total expenses, operating profits, cost of workforce. That one sometimes takes a little bit of work to get to, but all very, very doable, and headcount. So when HR says, oh, this looks too hard, we can't do it, I said, really? You can't get 5 numbers for prior year and current, prior period and current period? And by the way, just go to finance. They're going to have 4 of those 5 probably for you in 2 seconds, and HR should already have headcount. And by the way, all the orange ones are calculated, so they're just simply driven from formulas. The bottom 2 are the return on workforce metrics that I talked about. So for every dollar you invest in the human capital ROI expressed as a ratio, you're getting in the current period 1.3 back, or basically a 30% 9% return. That's outstanding, and that's our gross margin return. On a profit basis, so basically simply dividing net profit by cost of workforce, it's an 18.5% return. Still a very good rate of return, but the real impact, the real bottom line is, are we improving that? If you can improve your productivity, return on workforce every year consistently, that's a great thing. And by the way, you can actually add some columns to this and throw your forecast, your budget, your strategic plan numbers out, and you can actually use this. Remember I said you can use this actual tool right here, very simple, to model for the right size and cost of workforce and actually say we're going to increase productivity 3% a year, and here's the size of workforce, the head count, and the cost of workforce, the TCOW, that we could afford given our strategic plan targets and revenues and profits that would actually make that work. Voila. Wish I'd had that when I was a CFO. Okay, so, and you can see the red, yellow, green, some of the stories there. Let's jump to the next slide. We got just a couple more, and then we'll have some time for questions. So the next slide, so we've got some animation. Right now it looks a little bit crowded, but this slide is actually just, it's simply headcount. So it doesn't get much simpler than that, but it's a breakdown across some EEO, some basic workforce categories on the left, so really your top workforce categories. And then it starts with, we actually, believe it or not, used to call this a headcount reconciliation schedule, because we started with prior year headcount. You have new hires, you have terms or losses, which includes retirements, and then you have internal moves across categories, and you have the end number, which should reconcile from last year's headcount to this year's. But what we realized is it actually creates, it's more of a flow statement, hence the name flow statement. It tells a story of the flow of your talent from where area to area. So in the case of sales, if you just looked at the line for sales staff there, I know it's a little small, they had 3,000, they hired 860, they lost 450, and they had some internal promotions, probably some people promoted into sales and some people promoted out of sales into sales management. By the way, that's the build, is basically people moving usually through internal promotions or internal hires across categories. And they ended with 3,400. Well, if you're a publicly listed company and they don't disclose this, they would just say, oh, you know, we had a large workforce that we grew over 10% year over year. Well, great, but you know, if you were actually disclosing this, or if you're the CFO and you're trying to see where are things working, where are they not working, you might go to the head of sales and say, something doesn't look right here, because we hired almost 1,000, we hired 860, but we lost 450. And is it that we lost 450 of our new hires? Well, that means maybe something in our recruiting process is not right. We're not aligning, or we're not onboarding. Or even worse, even scarier, those 450 are those veterans that we lost from the group. So what's going on, and why do we have all this churn in sales? So that's just one example. You can do the same thing with management. You can do it with scientific staff, operations, service staff, and get a lot of insights about where the organization is doing a good job. And by the way, also, at the end of the day, is this the right shape of workforce? Are we allocating our workforce headcount, and hence our cost, in the right buckets and categories? Or are we getting a little overweight, as CFOs are always trying to kind of battle, in some of the service and support functions, as opposed to the actual selling and manufacturing and customer-facing roles? So one last slide, which is a breakdown of TCOW. And then we're going to dive into some questions. So for those of you who've been wondering what is TCOW, or total cost of workforce, you can it's actually calculated right here. And there's a little bit of a curveball here. You can see the top part is all workforce costs, and that's the bulk of the cost. The surprise is we actually add into TCOW, total cost of workforce, which is the bottom number here, HR cost. Why? Because if you don't have workforce, you don't need HR. You know, when startup organizations, when they get hiring that 5th or 8th or 10th employee, one of them is going to be a CFO, but you know, there's probably not going to be a head of HR yet, because until you have 100 employees or whatever that number is, you really don't need an HR function to manage them. It's something that management's going to do, unfortunately, in their spare time. And as you get bigger, the need for HR goes up and up and up. So in this case, for a relatively large modeled financial services company, they've got a big training budget, a large recruiting budget, and then everything else gets smaller. So you can see their total HR expenses, and interestingly, it actually shows them relative to the whole workforce cost. So which kind of makes for a different kind of discussion, as opposed to, I always used to go and know where to take money from HR, which is the training budget. We could all agree that training is critical, but my argument would always be, as a former CFO, that they could get the job done with $1 million less and add just as much value. Well, in this case, when you show it relative to the size of workforce that they're trying to manage and perhaps the ROI of growing talent, building versus buying, they might, if they were trained properly, might actually be able to make a strong business case for selectively increases in the training budget and perhaps taking away the money from other areas that are less critical. So with that, there's some examples, there's some metrics, kind of the whirlwind tour of advanced analytics, and how you can potentially connect it back to KPIs to better manage the business. So why don't we jump to the next slide and see if we've got some questions. Ernie, do we have any questions?
And ask the first question. Jeff, are you seeing an adoption of these human capital financial statements by industry? Are you seeing any industries that are leading the adoption of the human capital financial statements?
Great question. We're not seeing specific industries that are leading. What we're seeing is actually there are selected, obviously publicly listed organizations. There's some privately held organizations that are using some of these forms internally, and obviously they're not going to tell anybody, and neither are we, who's doing it. It's a great tool to use internally. Whether or not you disclose it or share it with bankers or public reporting is another matter. But what we're seeing is that some leading organizations, as part of their sustainability, so more and more organizations are issuing what's called a sustainability report. They're starting to disclose more and more of this information. One, by the way, that discloses a greater level of information is actually using these human capital financial statements, not disclosing the actual form and format itself, but some of the metrics from it in their sustainability reporting is actually UPS. So UPS is an example, Medtronic is an example, Starbucks is an example. These are companies that are really trying to be, and they're actually, I think they're very smart. They're trying to grab some brand recognition of, in terms of both sustainability, but also transparency, saying, look, we're trying to share more about what we do. We truly do say our people are our critical resource, our most valuable asset. So it only makes sense that we disclose a little bit more information about them. I would say that there's a global ISO standards initiative, which is working on human capital reporting standards to be adopted potentially either on a voluntary or required basis down the road for 150 countries around the world. There is actually an initiative to do that, and they've adopted some of these metrics and methodologies. I know because I'm actually a U.S. representative on the Human Capital Reporting Standards Initiative for the ISO Reporting Initiative and Task Force.
Great. Thank you very much. I have a few quick hitters for you, and just note I'll be launching the final polling question as we have our last question being answered by Jeff. Jeff, can you speak to the systems that companies are using to create these financial statements? Are people using Excel, or are there specific solutions that might be cloud-based that are allowing people to kind of automatically input data and to create the statements?
Yeah, great question. So, yeah, the number one tool is still Excel. And there are some other great visualization tools you can use for charting, but to just calculate, allocate, integrate the data to come up with these metrics. Actually, we have a tool, a software tool called Solve, which is a SaaS-based product which can do that. But to start simply to calculate the metrics the first time, I recommend actually using Excel.
Okay, great. Final question before we have our concluding comments. Is there any availability of benchmarks for companies who are creating these statements to benchmark themselves across companies? Is that public information, and is there data available for any private organization? So, for example, how are you able to benchmark UPS?
Great question. So in terms of productivity metrics, there is data out there, but it is difficult to get. We actually have a data, if you are interested in that, I suggest, contact myself, Ernie or myself offline, because we actually have a database of 7,000 companies across industries around the world for both large and smaller companies on these workforce productivity metrics. So that's where you can get some really good insight. Both the example was the biotech company and UPS.
Great. Thank you very much. Jeff, with that, I'll go ahead and close the Q&A session. So first and foremost, Jeff, thank you very much for your time and insights. Jeff is joining us from Asia. So, Jeff, we sincerely appreciate your thought leadership. Great job. Thank you, Jeff.
Thank you, Ernie.
And then just a reminder for those of you attending, if you'd like to receive a copy of this 2016 CFO Alliance Mid-Market Executive Compensation Study, an email to ernie.humphrey@thecfoalliance.org. Also want to mention there are some great resources relative to HR analytics on the Human Capital Management Institute site. Also would love for you to stay on after the webinar is over, and we appreciate your consideration in taking that survey. And one great thing about the survey is you'll have the opportunity to request a connection with Jeff with just a few mouse clicks. And finally, a big thank you to the audience for your valuable time today. Make the rest of your day great, everyone.